Welcome to the November 2025 edition of Let's Talk Markets. As always, our goal is to educate, inform, and empower the families and businesses we serve. And so, if you find today's discussion valuable, we encourage you to share it with others who might benefit from staying connected to what's happening in the markets and why it matters. And so, now before we get started, we want to take a moment and we want to recognize that this week marks Veterans Day. It's a time to honor the men and women who have served and sacrificed to protect our freedoms. And so to all the veterans and military families in our community, we just want to thank you for your service and your courage. Now, this month, we're closing out the year with plenty to unpack. Markets continue to push higher despite political noise. Interest rates are moving lower, and investor optimism has returned in full force. What a way to end the year, right? But as we'll discuss today, the optimism that we're talking about is starting to spill into maybe speculation. And we'll look how far this rally has come, what discipline really means in a market that seems to be and reward risk-taking. And then we're going to finish with an interesting look at the evolving world of AI and what it can teach us about long-term investing. All right, so let's dive in. And first, we're going to start a little bit about the markets, right? And we kind of look at this as a resilient markets and cautious optimism. And so even with the ongoing government shutdown casting a shadow over Washington, D.C., equity markets, they've continued their steady climb higher. It's kind of driven by a trifecta of positive surprises, cooler inflation data, and another rate cut from the Federal Reserve, and easing trade tensions between the U.S. and China. So let's take a look at inflation. Headline inflation ticked up slightly in September, but the core measure, which strips out food and energy, which we've talked about before, actually cooled a bit. While inflation remains above the Federal Reserve's 2% target, markets viewed this as progress. Right? The data helped ease recession fears and reinforce the idea that the economy is slowing without stalling. It's very important. Now look at this from the Fed. On the heels of that report, the Federal Reserve cut rates again in October. A quarter point, much like what we thought, that brought the target range from 3.75% to 4%. And that's what we see today. That move was designed to provide relief to a softening labor market and extend the economic expansion even as inflation stays elevated. Remember, at that 3% target. It's worth noting, the last time the Fed cut rates with inflation above 3% was back in October of 2008. That was during the financial crisis. Today, the backdrop couldn't be more different. Unemployment is holding near 4.3%, and the S&P 500 is sitting near record highs, up over 18% year to date. Now, what about trade and geopolitics? Markets also weathered a brief scare ahead of President Trump's trip to Asia. Concerns over tariffs and trade barriers sparked a quick pullback before rebounding after his meeting with President Xi signaled progress on reducing trade friction. But tech still leads the way. The mega cap tech continues to dominate market performance, and that's fueled by investor enthusiasm around AI and data center investment. You've heard these names before. We've talked about them. NVIDIA, Microsoft, Amazon, and Alphabet. They've led much of the rally, leaving many other sectors playing catch up. And so, in summary, this is still a market supported by resilient data. Remember, we look at the data, but not one immune to volatility. The economic backdrop is stronger than what most expected entering the year, yet expectations have also risen right alongside prices. So as investors, this is the moment to stay thoughtful, not fearful, to stay disciplined while recognizing that short-term pullbacks, they can still happen inside the long-term uptrends. All right, with that, let's jump straight into this month's market fact, or Ryan's market fact. And I got to tell you, this one is a really cool graph. It's called the $5 trillion Titan. Last week, NVIDIA officially became the first company in history to cross a $5 trillion market capitalization, cementing it as one of the most valuable companies on earth. Let's put this in perspective, and this is what this graph does. NVIDIA's market cap is now larger than Apple and Microsoft combined just 5 years ago. It's also worth more than the entire German stock market. You can actually add up Tesla, Meta, and Netflix and still not reach NVIDIA's valuation. At $5 trillion, NVIDIA represents nearly 8% of the entire S&P 500's market value. Now, the story of NVIDIA isn't just about one stock. It's about what happens when an idea, in this case, AI computing, moves from possibility to infrastructure. I mean, you can see this too, right? Look at this chart, and you can see that 10 years ago, NVIDIA had a market cap of $15 billion. 15 billion to 5 trillion. That's a 335 times increase. Kind of hard to wrap your brain around. Now, for years, GPUs, they've powered gamers, right? This was NVIDIA's niche for the past decade, but today, they power the global economy's AI engine. So that's something we thought that was worth mentioning. The first company in history to reach a $5 trillion market cap. Unbelievable. All right, now for kind of a quick market synopsis to kind of see where we've been over the course of the last year and in the last month. If you take a look at the year, you're starting to finally see the Dow and the S&P getting a bit closer to the overall returns that we've seen. At the Dow, about 12% for the year, and the S&P close to 15-16%. NASDAQ leading the way again at almost 20. But what's interesting to me is you look at the top 3 sectors this year. Once again, communication services is number 1, beats out technology at number 2, and utilities, of all things, at number 3 at 21% for the year. The bottom 3, all positive still: consumer staples, materials, and real estate, all in low single digits. Inflation, we talked a little bit about it. It's at 3%. Right? Y'all remember for just 18 months ago, 2 years ago, we were seeing inflation at 9% year over year, and we're seeing it at 3%. So it's come down substantially. But remember, once again, that still means things are getting 3% more expensive every year. It doesn't mean that things are getting cheaper, as we all know. And GDP at 3.8%. If you look at unemployment, it's ticked up a bit, right? 4.3% for the year. Now, our kind of big discussion that I want to have today is kind of playing with fire versus investing with discipline. Now, as often happens in a period of unrelenting gains, which it kind of feels like we're in at this point, investors are moving rapidly up the risk curve. Y'all remember the SPAC IPOs? Well, they're making a comeback again with over $22 billion raised this year, and that's the highest since 2021. I haven't talked a little bit about this in a while, but remember the meme stocks? They're back in the spotlight. And the latest wave is even more inventive. Leveraged ETFs promising 5 times the exposure to single names like AMD and Amazon and NVIDIA. And when speculative fever returns, the same pattern usually follows. Remember this, new products are built to meet the appetite of the moment. And some of them are engineered for trading, not investing. For excitement, not endurance. That's why one of the new 3 times short AMD ETFs just went to 0 after a 38% spike in AMD. And so that's what happens when leverage meets momentum. It works until it doesn't. And so that kind of raised a bigger question that I think is worth pausing on. What does discipline look like in a market that rewards risk-taking? Let me first start off by telling you what discipline isn't. Discipline doesn't mean sitting on the sidelines. It doesn't mean being pessimistic or missing opportunities. It simply means recognizing the difference between participating in growth and chasing euphoria. Discipline is the guardrail that keeps a good portfolio from becoming a gamble. Go to Vegas for that. It's knowing that not every shiny new product or stock is designed for your goals, and that sometimes the most responsible move is to say no when everyone else is saying, well, why not? So this is what discipline looks like. For us at Beavers Wealth Management, discipline is built into our process. It means this. First, process over prediction. When markets get noisy, go back to fundamentals and expectations. Evaluating earnings, cash flows, valuations, and data, not headlines or hype. Discipline means applying a consistent framework in every market environment. Second point, diversification, not concentration. Design portfolios for endurance, blending asset classes, balancing risk and opportunity in each sleeve. Third, it's rebalancing with purpose, right? Rebalancing keeps each portfolio aligned with your long-term goals. It's how we make sure risk stays where it should be, neither too high nor too low as market conditions evolve. You also have to evaluate risk. You can't just chase performance. You have to strive for efficiency. The goal is to reduce expected risk while maximizing expected return. And then you also got to focus on the why. And arguably, this is the most important. Every investment must serve a purpose within the bigger financial plan. Whether that's retirement income or education funding or long-term growth, discipline connects strategy to purpose. So that's what disciplined investing really looks like. Thoughtful, measurable, and intentional. So as investors, what do we take from this? Why is it important? So in last month's Let's Talk Markets, we looked at the timing graph, if you remember. It's a reminder that missing just a few of the market's best days, that can dramatically reduce your long-term returns. This month, we build on that same idea. The investors who've compounded wealth most consistently over time, they weren't the luckiest, right? You think of Warren Buffett. They were the most disciplined. They stayed invested through the noise and made decisions rooted in fundamentals, not on emotion. All right. I'll get off my soapbox here, but that's why discipline matters. It's what keeps portfolios aligned when markets are euphoric and when they're uncertain. It's the difference between chasing what's hot and building what lasts. That same spirit of discipline is what guides the way we review portfolios, not just for our clients, but for anyone seeking clarity. And so we've talked about this before, but when we offer our second opinion service, we're looking for the same things we emphasize here: a disciplined structure, balanced risk, and purpose behind every position. It's a complimentary review that can help ensure investments are aligned, risk is balanced, and opportunities aren't being overlooked. And we've seen firsthand how valuable this can be, especially in uncertain markets, which we are truly in. And so if you have a friend, a family member, colleague who you think might benefit, invite them to tune into Let's Talk Markets or connect with us directly anytime. We'd be honored to help. Okay, this next point is really fun. And we're going to call it the robot butler that really isn't yet. I'm not sure if y'all saw this, but I've seen it everywhere the last couple of weeks. Have y'all seen the new home robot called Neo? The launch video shows it folding laundry and doing dishes, watering plants, finding that remote you can never figure out where you put, and then docking itself to charge. Basically a housekeeper on autopilot. Sounds pretty cool, right? Take a look at this. You can even pre-order one today. $20,000 to own, or $499 a month with a $200 refundable deposit and U.S. deliveries supposedly starting in 2026. On the surface, it actually looks like the Jetsons finally made it to real life. But when tech journalists got their hands on it, the story kind of shifted. In the Wall Street Journal's demo, nearly all the wow moments were teleoperated by a person in another room wearing a VR headset. And so reality, early buyers are getting something closer to what I call Alexa with legs. It can answer a few simple questions, maybe even open a door or carry a cup, but it's nowhere near the sci-fi fantasy that we saw and were promised. And this story isn't unique, right? I've got a couple of things here that we've seen the same pattern repeat across plenty of new AI consumer products. I don't know if y'all remember this, the AI pen, which promised a wearable AI assistant that would follow you everywhere you go, ended up shutting down operations and discontinued cloud service just months after launch. What about the Rabbit R1, another handheld AI gadget shipped with a huge buzz, and then spent months pushing major software updates to get closer to what it originally promised? Even look at Apple. With all its scale and precision, it's delayed key features of its much anticipated Apple Intelligence rollout now until 2026. So we keep seeing the promises of AI is going to be getting bigger and even more exciting, and it is. But Gen 1 consumer devices just take time. And these are real productivity gains ahead that we'll see. We're just not there yet. And so investors, it's important to take a step back, specifically when it comes to AI. And here's how we think about where the value is being created today. We call it build it, power it, protect it. Given that we've got Thanksgiving coming up in a few weeks, I'm going to use a bit of an analogy of Thanksgiving to explain this, right? So the build it, that's the infrastructure. So think of this as the ingredients in the pantry. These are the companies that make the chips, the memory, the servers, and the cooling system. Everything that goes into the kitchen where AI is created. The second part of this is the power it, or the grid. This is the oven. Data centers and AI workloads are consuming enormous amounts of electricity, driving major investment in power generation, transmission lines, and substations. None of this works unless the oven stays hot, right? And finally, protected, or the cybersecurity. This is the smoke alarm, which have gone on a couple times in our Thanksgiving dinners. As AI expands, so does the risk, from data breaches to identity theft to AI model security. Cyber companies are protecting the kitchen while everyone else experiments with new recipes. So bottom line, this Thanksgiving, as we all sit down to eat, remember what ends up at the center of every table, right? Most every table, it's the turkey. It's the result of everything that came before it, the ingredients gathered, the oven that cooked it, and the watchful eye that made sure it didn't burn. The same is true for investing in AI. Enjoy the carving show, the shiny new gadgets and exciting headlines, but remember, where is the real value created? Own the pantry, the ingredients that build AI, the oven, the power that runs it, and the smoke alarm, the security that protects it. That's where the steady long-term opportunities live, while the consumer sides catch up. All right. We are so grateful you joined us today and encourage you to share this content with anyone who might find it valuable. And we have all the replays of Let's Talk Markets posted on our YouTube channel. And if you haven't checked it out yet, you should, because it's also home to our Beaver Nuggets and our own podcast, Between the Bears and the Bulls. We cannot wait to share with you our conversations with some amazing guests. So please be on the lookout for our emails announcing the release of our upcoming episodes. We got a heck of a one in store for you in December. And as always, if you have any suggestions on what you'd like to see from us, please let us know. We want to make sure the content that we're putting out is valuable for you. Okay, and one last thing to leave you with, and what do you call a turkey on the run? Fast food, of course. Remember, this is our last Let's Talk Market until 2026. And so we'll see you in January for the next edition of Let's Talk Markets. And as always, don't forget, leave it to Beavers.